some of the best deals I see are these projects that are in opportunity zones, primarily secondary, tertiary markets. And first of all, investment real estate's about two things, right? It's real estate guys looking for money and money guys looking for real estate, right? And somehow we need Blackstone to bring us all together. So my investment thesis is somewhat contrarian. Stay away from the herd, stay away from the herd markets, stay away from the herd capital. And it's another perfect tie-in with how opportunity zones work. There are great opportunity zone projects, and those projects exist in markets where we haven't seen a supply surge. Long-term wealth creation, ownership, new product. You've got a 5-year duration on that fund, and it kicks you back out in the market at a time, irrespective of whether or not it's a good time to ultimately sell real estate, right? It's kind of the fund tail wagging the real estate dog. So I see ground up development, when done and done right with the right partners and the right projects that have been pre-qualified, as really the way that real estate should be done, period. There are people that are gravitating towards this because of the impact component of the investment, right? And you can make an impact investment and have it still be a very good investment.
Okay, thanks for coming, everyone. We're so glad that you're here today, and thanks for joining us with the team here at OZListings. We're going to be interviewing a market professional who I really am excited to learn more from today about the opportunity zone space, the unique alignment with family offices, and also what tends to be the typical interface between these types of projects and how this all is coming together in the market. We're interviewing specifically Todd Vitzthum from Acara Management today. And for anyone who hasn't met Todd, I've spent a lot of time with him over the years. We've done a lot of projects together, and one of the smartest, most dynamic, most experienced people I know. So I just want to put my 2 cents in on that. But you'll get your own read on Todd today. Let me bring you up on stage here, Todd. First off, let's just start everyone likes a little soft intro. So why don't you just tell everybody a little bit about yourself? We can keep that part brief, but who's Todd Vitzthum?
Thanks, Jeff. Thanks for the kind words. And I'm excited to be here. So I guess to go way back, I'm from the Midwest. I grew up in a small farming community in Iowa. I came to San Francisco via Denver during the tech startup boom. We had a tech company right after the dot-com bubble burst. I moved into commercial real estate. I've spent the last 25 years in corporate commercial real estate, primarily on the institutional multifamily side. Live in the Bay Area, spend time in the Central Coast, wife, 3 kids. Yeah. So
that's awesome.
That's me.
I love it. I saw a little bit, just for all of the people who are kind of have inside knowledge today, there was some information about these rural opportunity zones and how things are getting redefined. And I know you're from the Midwest and you're really excited about kind of how that's going to pencil in the months to come, I think.
Well, yeah, that's a really good kind of entree, because there's kind of a drip system of information coming into the OZ world, and post the big, beautiful bill, all of these things are now being defined on how it's actually going to work moving forward. We're super excited about the additional benefits of rural opportunity zones. It plays into our overall investment thesis. And I've got a soft spot for some of these tertiary markets, and I like spending time there. I think there's a migration pattern moving in that direction. And the fact that we can use this great platform to create jobs and housing in these underserved communities is something that we're very passionate about.
Well, I love that. And I want to get to that investment thesis in a minute. I'm sure a lot of folks will be interested, especially with your background. And I know the breadth of knowledge that you have, especially in the real estate space and corporate commercial real estate space, ground up development. And that tends to be where opportunity zone projects go to live and thrive. And so I'm excited to learn more about how you've made this, how you underwrite, how you think about this, because I think a lot of people want to have access to your DNA on these types of projects. It's how you've been so successful. I'm curious, backing up maybe, how did you first get involved in opportunity zones, just kind of from the get-go?
Yeah, good question. Well, so my background, again, 25 years in institutional multifamily. Coming out of the financial crisis, we were at a point in the market cycle where there was a very low transactional velocity for apartment buildings. That was my business. I sold big apartment buildings, and the market was shut off. And in California, where we're highly impacted by market cycles, we were just trying to reinvent the wheel. So we moved up the food chain. We started selling dirt to people who were building apartment buildings. And at the time, there were a lot of remnant entitlement deals in California. In California, it takes 5 years to entitle a development project. So a lot of those projects had gone back to the bank. A lot of landowners had really been impacted by the market cycle. But as the market started to move back in favor of feasibility, we embraced that category of business. And ground up development for high density housing is not a specialty practice group in commercial brokerage. Multi-housing is, but we were guys who sold apartment buildings. When it came to development, it's a very nuanced business with layers of, I don't want to say complexity because it's all real estate. None of it's really rocket science, but it involved the focus of building a capital stack to make sure that that project was successful. That meant debt, that meant equity. It put us in the equity markets. And we started paying very close attention to where the money came from. So along comes opportunity zones 8 years ago. And a lot of smart people in our industry took a peek at opportunity zones, were overwhelmed by the complexity and just went back to doing what they were doing before. Right. We took a deep dive and it just went down that rabbit hole. And we discovered some really unique value propositions in that space, which at the end of the day, opportunity zones are a different way for primarily development sponsors to source the much needed equity to build housing. And it correlates really well because that capital moves into markets where traditional institutional equity hasn't been available. So that was kind of our entree point. And so now we work with developers across the country. We work with high net worth investors and family offices and large cap gain clients. And we introduced the two.
Yeah, it's interesting. And I know that today's call, we've drawn a lot of folks in who are in that family office community, the greater community of family offices, and whether they be fund managers or folks who are risk strategists. There's a lot of folks who are kind of joining us today, and I'm sure some industry professionals as well. I'm curious, specific to family offices, I saw some statistics published a while ago, and I don't know how accurate they were, but basically a very large number of family offices, it should be all of them, know that they should be involved in this space. And yet the overall adoption trend has been subpar. But what's driving that disparity between kind of knowing where we need to be and getting there?
Again, really good question. My experience is somewhat anecdotal, but I think it represents a broader scope of what's kind of the challenge with this. And first of all, investment real estate is about two things, right? It's real estate guys looking for money and money guys looking for real estate, right? And somehow we need Blackstone to bring us all together, right? And again, Opportunity Zones has created this wonderful platform where direct investment capital fits really well into the model of opportunity zone projects, opportunity zone businesses. So we're helping these sponsors source this capital directly.
This adoption disparity between family offices, knowing where they want to be and then getting there, right?
So I was a real estate guy, helping real estate guys look for money. And now we're on the other side of the equation where we're helping a lot of high net worth investors and family offices look for real estate. And they're not historically in the path of great deal flow, but I've learned a lot more about the family office industry. This is a cottage industry, and there are twice as many family offices as there were pre-financial crisis. So it's a growing category of business we're all trying to figure out, but it's not about the family business. It's about the business of being a family. And the primary focus of that business of being a family is generational wealth preservation, which inherently brings us back to kind of a conservative approach to this wealth creation, wealth preservation.
Sure.
And because opportunity zones are primarily in the ground up development space, you can't buy an existing project. It's not a value add execution. It's a ground up development. It's hard for most investors to define the risk profile of a ground up development deal. And so we see a lot of people who get in the family office space, who get the formation part. We understand the tax benefits. We've formed a qualified opportunity zone fund. We're managing that fund for reporting and compliance. But where's the deal flow? And how do I tell a good deal from a bad deal? So we spend a lot of time in that space working with both developers and high net worth investors to really, at the end of the day, bring the best deals to the best investors. And I think you're going to see a much broader adoption amongst family offices moving into OZ 2.0. But one, it's been confusing, right? From a legislative standpoint, anytime there's tax legislation involved, it's confusing. But also, how do I find the right deals? Right? We've seen a lot of people get the first part right and then put good money into bad deals. So we're all about vetting the deals, vetting the sponsors, making sure the right deals get funded, defining feasibility, all of that. So
I love that. Well, I know kind of one of the core principles for wealth preservation, just globally, would be this idea of risk mitigation. And so, how do you, and this may transition into some investment thesis, I suppose, but a lot of these projects and opportunity zones are ground up, which
yeah.
I think historically has been viewed as a higher risk category. And so now we're trying to figure out, okay, well, how do we bring a lot of capital, a lot of this capital gain into this space, which feels like maybe it has an inherent risk baked onto it? What are ways that you look at in terms of minimizing risk in these opportunities on types of projects?
Yeah. So there is a higher risk profile associated with ground up development. And part of the problem is the traditional approach to that category of business. It's been driven by the institutions. Institutions are driven by an IRR metric. So their fund has a duration, right? If you invest in a Carlyle or Berkshire fund, a big institutional fund, you're investing in a fund that is targeting a mid-teens IRR. So you've got a 5-year duration on that fund, and it kicks you back out in the market at a time, irrespective of whether or not it's a good time to ultimately sell real estate, right? It's kind of the fund tail wagging the real estate dog. So the first thing we do, and this is another great benefit of opportunity zones, it's a 10-year hold, right? So I see it as 2 bites at the same apple. If you're an investor in an opportunity zone project, you get that pop of building into a profit, right? And most developers build into a targeted 25% profit. So you can build into a profit, but then the structure we like to use is that deal gets crystallized. It moves into a 10-year hold or a collective 10-year hold from the time that the fund was formed and went into the business. So you get that capital event through permanent loan proceeds. You're going in at 60% loan to cost on the construction debt. You're building to a 25% profit. You're stabilizing with takeout loan proceeds at 70% loan to value. There's a recapitalization event if things stay stagnant, meaning rents don't go up or rates don't go down, that returns a significant portion of that equity. So you get a lot of your equity back at that crystallization moment, and you maintain participation in that deal long term. So I see ground up development, when done and done right with the right partners and the right projects that have been pre-qualified, as really the way that real estate should be done, period. You're owning brand new real estate in markets that you select. You're getting that profit pop. You're getting long-term participation. You're getting a return of equity, and you're creating long-term wealth through a tax mitigated envelope of tax-free cap gains.
I love it. Well, and you're effectively playing with the house's money, which is a fun side effect, right? This is really interesting. And I appreciate, just hearing you talk about it gets my head going in a lot of different directions. So let's take a quick turn for a moment. I want to come back to the investment thesis because I could listen to you talk about this all day. It gets exciting for me. Why are we hearing so much right now about distress in the real estate space, right?
Yeah.
You hear this, you watch the news for 10 seconds, and obviously that's their job, is to try to scare you. But we're seeing lackluster deal flow. You would anticipate not that. And so I'm curious, what's your perspective on that, and what's creating that in the marketplace?
Yeah, so let me talk about my investment thesis a little bit. And we started doing work in the national market. We have a national platform, so I get to talk to developers all over the country. And real estate is really a kind of a tale of two cities, right? They're institutionally driven markets, and then they're secondary, tertiary markets. And if you look at Austin, Texas, or Nashville, or Charlotte, or Jacksonville, or Salt Lake City, or Phoenix, I mean, you had every institutional fund had the same good idea on the same day, and they built 15% of the overall stock in Austin, Texas, which was under construction at the same time. And now we're seeing the back end of that. So my investment thesis is somewhat contrarian. Stay away from the herd. Stay away from the herd market. Stay away from the herd capital. And it's another perfect tie-in with how opportunity zones work. When you go into these secondary and tertiary markets, we see developers who are generational developers with deep knowledge on the local markets. They're vertically integrated. They've got a GC component to their platform. They're building into these incredibly feasible deals in markets where there hasn't been a supply surge. So we really like to bring them the type of capital they need to build and hold long term. So everything kind of ties in really nicely on, kind of how opportunity zones work for the development sponsor. But yeah, that's kind of the high level overview of how we're approaching that.
I appreciate that. And so as we're seeing this distress kind of signal out there, what's creating that disparity? Because that's actually, I like that you segued there. Because I still see this, it's kind of the news headline, right? Everything's bad. It's all
It
falling
is.
apart. And yet the deal flow seems choked.
It's a little schizophrenic, right? I read an article this morning about how we're oversupplied and there's no feasibility, and then another one about how rents are rising and absorption's at an all-time high, right? So again, if we look at where we're at in the market cycle, this is a incredibly unique market cycle where everything was moving in the right direction pre-COVID. The feasibility stars were aligned. We were adding supply at a historical pace. And then all of a sudden, COVID shuts down the economy. We create liquidity, which creates inflation, which creates rising interest rates. So that the developer was building based on a 5.5 yield on cost to exit at a 4 cap. He exits in a 5.5 cap environment. So that is what creates this type of distress. And you hear a lot of this out there. There are 500,000 units across the country in the production pipeline. And I would speculate that over 80% of those projects, which are primarily in institutional, are worth at or below what they cost to build, just based on the shifting metric of that cap rate. So there is distress out there.
Yeah.
But going into these projects, there was 60% loan to cost. There was a 40% equity cushion. So even if they drop 10, 20, 30%, you've got a sponsor who's trying to preserve that equity. He doesn't want to liquidate at the bottom of the market. And he's waiting for the days where rates come back down so he can finance out of it. But he's trying to preserve that. So we've got this category of business that's rescue capital, right? All this rescue capital comes pouring in, which is pref equity, which developers are averse to because it's usually accruing at a high pref. They don't want to stop the bleeding only to die as a slow, painful death. So
right.
These people are holding on to trying to earn out of this tranche period of the market cycle. So there is distress, but there's very little willingness for sellers to meet the market unless they absolutely have to. But there are other ways you can access those deals through participation, which is one of our kind of current secret recipe ideas around how to benefit from today's market value, but not be forced into the mass audience of people who are out there trying to buy distressed deals.
I love that. Well, and without giving away the recipe for Coca-Cola here, it's great. You have a bit of a reputation for being very resourceful, we'll call it. I think in whether it's this space or others, I think a lot of that is just you've seen enough deal flow over the years to start to understand where the moving parts are and how this can all come together. And strategically, that's a really huge advantage. Speak really quickly. I know that the team that you work with is regularly stepping in and correcting major issues, let's call it, that have arisen in the space, whether it's on the developer side or for that matter, even just captive funds. I know it's not ill intent, let's call it, but what do you think is creating the number of mistakes that you're seeing out there in the opportunity zone world, whether it be just formation or just kind of all of these things? What's creating all of that?
No, it's a really good question. One thing I will say is when we started to build our team, we recognized how there were multiple kind of complementary skill sets required to get the opportunity zone business correct, right? And I'm the real estate guy. Everyone on my team is smarter than me. One of my main partners is a real estate attorney who's an outbound attorney. So we're introduced to the business of real estate. It's a fund, right? So there's SEC compliance and there's FINRA compliance. And a lot of real estate guys went out and formed a qualified opportunity zone business and a qualified opportunity zone fund to get access to this unique category of capital, which was great. But the execution and the service industry that supported that execution hadn't really been formed yet.
Sure.
So you go to your attorney who was your transactional attorney and he'd do some of the opportunity zone stuff, or your CPA. And now we're looking back at this, and unfortunately the things that were done wrong that kind of unwind the deal, or how it was structured, or a form didn't get filed, or so, you got to get the compliance side of it down to make sure you're safe and solid before you even think about the deal side of it. So the good news is a lot of this is salvageable. There's some restructuring that gets done. There's some penalties that get paid. But moving forward, we're Acara Management, my company, we're very focused on just helping that real estate developer do everything they need to do right day one. Form the QOZB, do the asset level testing, form the QOZF, build their qualified opportunity zone business in a way that attracts the right type of investment capital. And then we step in and we do long-term compliance and reporting and structuring.
For like over the long haul. That's
Yeah.
interesting. And I've looked into that kind of out there in the marketplace. And I believe that it's a very unique niche, which I think is exciting for folks to learn more about. So I'm curious, kind of different category here. So we'll change lanes. What type of opportunity zone projects do you typically see right now? And what are you looking for?
Yeah. So back in the early days of opportunity zones, everybody had an opportunity zone fund. Every conduit that was raising capital created an opportunity zone fund. And based on the tax deferral benefits alone, a lot of these funds were raised. And then they shifted into deployment. I was on the real estate side, so I was interacting with a lot of these qualified opportunity zone funds early on. And we saw that there was a significant disconnect between their knowledge and ability to invest in real estate and how it was being done at the executional level. So now here we are back at the beginning of what I think is really the onset of what's going to be a sustainable opportunity zone industry. And we're seeing deals done and done correctly. And we're seeing the right type of capital be introduced to the right type of real estate. And I don't know if that fully addresses your question, but we've seen an evolution in the industry that is quickly moving in the right direction.
Well, it does. What types of projects are you kind of keeping your eye on?
So
like for you, what gets you excited if you find a project?
Yeah. So, early on when we were looking at opportunity zone projects, there were a lot of developers out there who woke up one day and realized they had a deal in an opportunity zone, right? And there's still a lot of that kind of cottage industry, secondary, tertiary market impetus into the opportunity zone space. And so we look at a lot of opportunity zone deals, right? And the ones that we try to identify, first of all, we look at sponsors first, deals second. Doesn't matter how good the deal is. If the sponsor's not good, it's probably not going to be a successful partnership with an investor.
I love that.
So, and another benefit I've had of being in the development space is I've worked with development sponsors across the country, and there's a lot of good ones out there. And not that they're bad ones, but the merchant build model that exists in primary institutionally focused capital markets, it's a different business model. When you move into these secondary, tertiary markets where these guys are building to hold long term, those are the type of sponsors we look for. My favorite type of development sponsor is when I bump into somebody who's an expert in their region, right? And they know every deal and where every body's buried, and they know every fundamental metric, and they're building the project and they're highly efficient. And they say to me, we've got 7 deals in our pipeline, 2 are in stabilization and 1's under construction, and every other one we're trying to figure out where to get the money for. And oh, by the way, 1's in an opportunity zone, right? So you've got this highly capable developer who's got this incredible value proposition and is operating with all these efficiencies, but they just haven't put the pieces of the opportunity zone puzzle in place. So right. I know I've got a great sponsor. I know I've got a great market. I know I've got a project that we can agree on based on certain fundamental metrics hit our feasibility thresholds. So I've got a good sponsor. I've got a good project. I've got a good long-term programmatic relationship with this group, because what typically happens when we interface with these groups and we fill in the missing pieces of the OZ puzzle to help them become successful opportunity zone sponsors is they embrace the OZ category of business. They go out and look for OZ deals. We go out and look for them together. And it's a whole different category of development that we're executing with these sponsors. And we've got a great programmatic long-term relationship that works incredibly well in alignment with what we see is often the thesis or the strategy for these high net worth investors. They want to be in these good partnerships with sponsors with this robust value proposition where everybody likes each other and everybody's working direct, and we're not doing it through this huge institutional fund conduit that at the end of the day is making all the money.
Yeah. Right. Well, and it's interesting that you mentioned that. In fact, I wanted to share, we had one of our more recent listings that arrived on the OZListings platform was the folks from over at Up Campus. And I know you're familiar with, actually, it's funny, anytime I scratch and sniff into a deal, I find out that you've been involved or have had chats with somebody or have just consulted. And I know this isn't necessarily one of your projects, but these guys are doing great work. And it's interesting because it feels representative of that category of business. And I would encourage anybody on the call, go check this out. It's interesting and you can kind of see the platform. And I would say, spend the time with this deal to go to the bottom, request this vault access or contact these guys. It's always a good thing to do to learn more about a project like this one. And in fact, I'll put the link to this project here in the chat for everybody. But what is it about a deal like, for instance, the Up Campus deal there in Reno that seems to align with that thesis for you? I know that you know the guys over there at Up Campus. Is it really it's start with the people first, it sounds like?
Yeah. Well, of course, that's a perfect example. This is what I love about the space. One of the best student housing developers in the country, building projects all over, very successful track record, incredible people. And they've got a project in Reno and an opportunity zone, right? So they reach out to us.
Right.
And we start a conversation. But really, this is the partnership you want if you're a family office, right? Incredible category of business, student housing, incredibly resilient. These guys are highly sophisticated, institutional, long background of sourcing institutional capital. Well, now there's this new category of business and opportunity zones, which, by the way, correlates really, really well with student housing and rural markets. So you get all of these benefits, and it's unbelievable. And you build a student housing project in a tertiary market, you get the benefit of the stepped up basis, you get the development profit pop that you participate in, and then you convert to long-term ownership and partnership with this group. And then you just do it again and again. And you've got the makings for what really equates to long-term wealth creation and wealth preservation. So yeah, that is probably one of the best examples of how a great sponsor moved into the opportunity zone space and then now is embracing it.
That's awesome. Yeah, they're great guys. Spend a lot of time with them. So I'm curious, and I'd be remiss if I didn't ask, because I've heard you speak to this point, and I've always found it to be really from the heart for you. I feel like there was strategically an intent of the Opportunity Zone program when it was introduced in the United States. And that intent wasn't just only about making money, it was about incentivizing certain things. And there's an impact to that when it's approached appropriately and correctly. And so what do you believe to be kind of the heart of Opportunity Zones? What's the beating heart of this program? And if it's used correctly, what do you think is possible here? And not to get too we are the world, but I do think that there's some impact that's possible with this.
Listen, I've spent a lot of time in affordable housing, right? I believe in the mission of creating affordable housing historically, and I'm not a particularly political guy, but, in the past, we used tax revenue to subsidize the creation of affordable housing, and it was really highly inefficient, and you can't subsidize your way out of a housing crisis.
Right.
Opportunity zones come along, and it's just a different political framework, which is pretty bipartisan, right? It's hard to argue against the benefits of opportunity zones, but there are people who see this as, it's just a tax break for the rich guy. But anytime you incentivize the placement of private capital through tax mitigation strategies to the creation of jobs and housing, back on the farm, we call that a win-win, right?
Right.
And so I love that this is now being implemented. I love that it's now permanent. I truly believe that we can, and you see this a lot in the cottage industry of opportunity zones. There are people that are gravitating towards this because of the impact component of the investment, right? And you can make an impact investment and have it still be a very good investment. So we love working with those folks and we love guiding them into the right types of projects with the right types of partnerships. And I think at the end of the day, if we do this and do this right, and this is what you've done, Jeff, you've created this marketplace, right, where capital finds real estate. And before, I'm a real estate guy, so I know if you have a piece of real estate to sell, you put it on LoopNet, you find a buyer. If you are a GP or a developer sponsor looking to raise equity, how do you socialize your project to raise that much needed capital? And you've created that marketplace for this, and I think it's incredible. And by doing that, we'll do our part. We'll bring the investors into the arena. We'll bring the real estate developers into the arena, but we can literally add hundreds of thousands of units of housing that would have otherwise not been built or funded if we wouldn't have all found each other. So I think of it this way at the end of the day. If we could just flip a light switch and all of a sudden all the feasible projects across the country lit up like a black light, and we could pick those projects out, the best ones, so we could guide this investor capital into the best projects, that's the way it should work. And that's, I think, the mission that you and I share. We're trying to create this free flow of capital into the projects that really should get built.
I love that. I've heard you speak so many times about this topic of opportunity zones don't make a bad project into a good project. They can make a good project great. And I know that's a cornerstone philosophy. What do you mean by that? And how does that play out kind of across the marketplace in general?
First of all, there's a lot of alignment with where we're at in the market cycle and where there are opportunities for highly feasible deals. right? So let's just dispel the myth that opportunity zone projects are not the best deals, right? Some of the best deals I see are these projects that are in opportunity zones, primarily secondary, tertiary markets. Let's take a housing project, for example. You've got the area of land where you can build a project to scale in a very cost-effective construction model, right? You're building 25 units to the acre, which costs half as much to build as 100 to the acre where you're going straight up with concrete, right? So there are great opportunities on projects, and those projects exist in markets where we haven't seen a supply surge. Long-term wealth creation, ownership, new product. But you're right. When opportunity zones first came out, we saw some good money go into bad deals, and opportunity zones will not make a bad deal good. They can make a good deal better. But I'm always describing this to my developer clients. The benefit of opportunity zones belong to the investor, not to your project, not to you as the sponsor. The benefit of you as the sponsor is you're going to get to source a bucket of capital that would have otherwise not been there for your project. So you get to build your project. We're going to form a joint venture structure that's highly favorable to both of you. But the benefit on the back end, all the tax mitigation strategies, those benefits belong to the investor, right?
That's awesome. Yeah, that's the kind of the cornerstone of this whole program is creating, and I love that you talked about this idea of subsidization versus incentivization, right? Neither one is good nor bad. It's just what's going to work. What's really going to get to the heart of creating, as you put it, affordable housing across the United States. And that really is a cornerstone philosophy of this entire bill. It's part of the reason why I believe, at least, just got renewed and extended and became a permanent now part of the tax legislation.
Yeah.
So it's really critical and exciting. So if you were speaking directly, I'm just curious, to, let's say, a family office, they're interested in this space. They've maybe had a little bit of a fear of missing out in addition to their fear of getting started. How do they break in? What's the appropriate next step? I mean, is it call you, a better call Todd kind of a thing? How do they get involved?
First of all, theory of abundance, right? I want anyone and everyone who wants to participate in the opportunity zone space from a service model, from an investment standpoint to participate. There's so much opportunity out there for us. So if you have a question, if you have a thought, if you have a problem, I love talking to people about this. If I don't have the answer, which I often don't, I can point you to someone in the industry who does. One thing that I think we're kind of particularly proud of is we've collected some really, really good people across the country who are extremely good at this. You know, we're working with some of the best tax attorneys and real estate attorneys and securities attorneys across the country that really do have kind of a mission basis for this approach. So yeah, call us. I'll point you in the right direction. We do have a business model that we've reverse engineered for our clients to build around the development sponsor who's looking for capital and around the high net worth investor who may have had a big capital gain, who wants to figure out how to navigate and participate into the opportunity zone space, from fund formation to fund management to a bespoke level hands-on approach to how do we deploy that capital. And that means real estate. It means investing in businesses. It means maintaining that structure for long-term compliance. And I could go on and on all day about how we've built that business model, but I will say one last thing. Keep in mind that if you've had a significant capital gain, it may be in your best interest to form a captive qualified opportunity zone fund, start that tax deferral, move it into some QOZBs. Almost every QOZB at this point will take a sidecar qualified opportunity zone fund. And keep in mind that that 10-year hold period exists at the QOZF level. So you can move your money in and out of deals. You can recoup your initial investment capital and still have chips on the table. So there's so many different ways that we're approaching this that benefit that family office high net worth investor. And my team includes attorneys, and we've got an AI team, and we've got the real estate guys and tax attorneys. And so I like to think we're doing it right.
I love that. Well, so yeah, absolutely. And by the way, we put your email address there in the chat for anybody who might have a question today, and we'll put that with the recording afterward. And by the way, thank you for being here today. I really appreciate it.
Yeah, love it. Thanks.
So great. I'm very excited. So let me ask, just kind of casually, as we're tightening up or wrapping up the call or what's your sentiment around 2026, 2027? How are things? Are you optimistic and excited? Is it doom and gloom and head for the bunkers? What do we think moving forward?
You know, COVID wasn't fun, right? I mean, it really shifted the way. Just when I thought I had real estate figured out, everything in the world changed. So we've adapted. It did give us a good reason to move deeper into the opportunity zone space. We're building a couple prop tech and fintech models. So I love what we're doing, but I also think we're in this very unique market cycle where we've shut off production for housing. We have this massive demand for housing, and people always question that. It is very regionally driven, but pre-COVID, the average tenant was 30 years old. Now the average tenant is 38 years old, right? These renters by necessity based on this affordability issue in this new interest rate environment is a very real thing. So we are massively undersupplied on the housing side, right? From a rental perspective. So I think being counter-cyclical, build off cycle, deliver on cycle, right? The institutional equity groups are shut off for funding ground up development projects. But if OZ moves into development, we're going to be delivering these projects at a time where rents are going to be going up, even if interest rates don't come back down. But if they do, think of what happens if that 4.5 cap exit strategy goes back down to a 4 cap exit strategy, right? Do the math on that. It's compelling. That will return all of your equity. Right? Yeah.
Yeah, it's huge.
So I'm optimistic about the next couple of years in the housing sector.
I think we share that, and we've chatted about that. Okay, so maybe last question, I guess, but I'm not really sure what drives this, but I see a lot of do-it-yourself creeping into the space. Well, I can figure this out, or I've got my CPA down at the, hopefully not strip mall, but it feels like there's this kind of like, I'm just going to figure it out, and there's a lot of cost cutting to try to get into the space. And I know there's a number of hurdles in the opportunity zone world, and I think that has maybe acted as a deterrent, given the upside. And I feel like I know your answer, and maybe I'm even prompting it a little bit here, but what's your thought on do-it-yourself versus working with experts? I know the team you have around you. Like, when you compare those two, is there any value in trying to tackle any of this yourself, or do you just seek expert help from the beginning?
There's a guy at my local farmer's market, right? And he's a one-man band. He plays the guitar, he's got the cymbal between his knees, and he's got a drum that he's hitting, and you can kind of tell that it's a Beatles song, but you don't really know which one it is, right? And then you go, I would equate this to more of a kind of a symphony. You've got to conduct it. You've got to do it just right. Things have to happen at the right time. What I find most often with my real estate clients is they just want to build real estate, right? They don't want to raise capital. They don't want to form a business entity that's a QOZB, that's a fund, that's FINRA compliant. They want someone to do it. And like any other industry, if you find someone who does it and that's what they do and they focus on, it's highly, highly cost effective and highly efficient. That's what we're striving for, right? We want to fill in all the missing pieces of the puzzle in the most cost effective way possible. Same on our white glove program, which is designed for investors with large capital gains. We want to help them navigate the opportunity zone industry to maximize whatever their objectives are based on their unique criteria for investing in businesses or real estate for compliance. So we just kind of fill in the missing pieces,
I love
the
that.
rest. Yeah.
Well, it's a great approach, and it's obviously it's going like gangbusters. So congratulations.
Thanks.
And we're going to have you on again soon. And I think actually we have scheduled, I'll have to look at the calendar. I think we're speaking with Michael Krieger, who I know is, that's exciting.
Smarter than I am, one of the best opportunity zone attorneys in the country. He'll be on, when did you say, couple weeks?
You're doing few weeks. Yeah, we'll get that out to everybody who's here today.
He and I do take a lot of calls together. He can help on the front end with the legal entity, the formation, not only just filing for a QOZB or a QOZF, structuring in a way that is built to attract investor capital, right? Helping the deal structure. So it's not just legal, it's really, the joint venture. And so he's an awesome guy, but call me and I can intro to him.
That's great. Well, and just a shameless plug here, we're at the tail end. Anybody who's interested in learning more about opportunity zone listings that are out there and really increasing your understanding of this space, head over to OZListings.com. And of course, we'd love for you to join our community. We have a lot of new deals that are going to be coming on as well in the coming weeks. So we're very excited about what's to come. And the ramp up, the energy that I'm feeling aligns perfectly, Todd, with your sentiment around how things are going to pencil over the coming months and years.
All of our deals will, if I have anything to do with it, will wind up on your platform. I'll help you with your shameless plug. It's a wonderful arena to give a good opportunity zone project exposure to a broader investor base, right? It's just pouring gasoline on the fire that is your investor Rolodex. And it's also a resource in a marketplace for high net worth investors who are looking for quality deal flow and quality sponsors. And you guys have been great at that.
What's great about a marketplace as well, and I know you feel this way because we've consulted back and forth so much, the reality is that it can be driven in large part by the user. And so I would encourage everybody to go over there, give us some feedback. Tell us what you like, tell us what you don't like. Of course, we'd be excited to receive that feedback because that's how we grow and also reflect back to the greater market what everyone really wants. And that's what we're here to deliver. So
tell me again what the goal was, Jeff. Was it 1 million accredited investors?
Accredited investors. Yeah. Yep. Yeah. And we're rapidly moving into that category, which we're very excited about. And
that's awesome.
Getting in touch with all the right folks. So thank you again, Todd Vitzthum, Acara Management. And for anybody who wants his contact information, of course, we'll post it below the recording. And stay tuned for more announcements. If you just simply go plug in over at OZListings, you'll be in the loop when we have a great presenters like today. But Todd, awesome as always. And thank you. I hope we can have you back sometime soon.
Yeah. And Jeff, if there aren't any questions now, I'm very accessible. People can email me. People can reach out anytime. I love talking about this and helping in any way that I can.
You bet. And if we didn't grab one of your questions today, or for some reason we missed something, feel free to reach out to Todd directly. Like I mentioned, we'll give out his contact information so that you guys can access that resource. Okay. Thanks again, Todd.
Cool.
Appreciate it, everyone.
Thank you, Jeff.
Have a great day.
Thank you. See you.